Right now, the national average interest rate on a savings account in the United States is 0.38%. In our last two videos, we covered credit cards charging 25.2% interest and buy now, pay later fees running 5 to 8%. So here's the question worth sitting with for a second. The same banks paying you 0.38% are, in many cases, the same institutions lending money out at 9, 15, sometimes 25% or more. That's not a small gap. That's a gap of 20 to 60 times on the exact same dollar inside the exact same building. In the first quarter of 2026 alone, FDIC-insured banks reported $80.5 billion in profit. Today we follow the money into the plainest, oldest profit engine in all of banking, using data from the FDIC and the Federal Reserve, sourced on screen the whole way through. Let's get into it. Here's the mechanism, and it's honestly simple once you see it. A bank takes your deposit, your checking account, your savings account, and lends most of it back out to other customers as mortgages, car loans, credit lines, business loans. The rate they charge borrowers is higher than the rate they pay you. The difference between those two numbers has an actual name in banking: net interest margin. It's not hidden. It's reported every quarter in public filings for every bank in the country. As of the most recent data, the industry-wide net interest margin sits at about 3.39%. That single number is the core engine behind most of the profit we're talking about today. And it's worth remembering as we go, because everything else in this video is really just different ways of asking the same question. Whose side of that margin are you actually standing on? Worth noting, too, how this compares to what we've already covered on this channel. Credit card interchange is invisible to consumers but disclosed to merchants. Buy now, pay later interest is disclosed, but easy to miss inside a familiar-looking checkout screen. Net interest margin is disclosed more openly than either. It's sitting in a public quarterly report anyone can look up. And yet, of the three, it's probably the one fewest people have ever actually heard of, let alone checked for their own bank. Pillar 1. The spread itself at scale. 3.39% might not sound dramatic on its own, but banks aren't earning that margin on one account. They're earning it across trillions of dollars in deposits, simultaneously, every single day, without pause. That's how a spread measured in a handful of percentage points turns into $80.55 billion of quarterly profit across the industry, and a return on assets of 1.26% industry-wide, actually higher, at 1.42% among smaller community banks specifically. And unlike the credit card interchange, or buy now, pay later fees we've covered in previous videos, this one doesn't require you to swipe anything, sign up for anything, or opt into anything at all. If you have a checking or savings account anywhere, you are already a small part of the machine that generates this number, just by leaving your money where it already sits. That's pillar 1, and it's the baseline. The next part is where it gets specific to you, and where the design gets a lot less accidental. Pillar 2. Why your specific rate barely moves, even when the Fed's rate moves a lot. And we actually just lived through a real-world demonstration of this, not a theoretical one. Between 2021 and 2024, the Federal Reserve raised its benchmark rate from near zero to more than 5%, one of the fastest hiking cycles in decades. If deposit rates simply tracked the Fed one for one, savings accounts should have climbed dramatically over that same stretch. They didn't. According to FDIC data, the national average savings rate never even climbed above 0.5% during that entire multi-year cycle. Loan rates, on the other hand, moved almost immediately. Mortgage rates, credit card APRs, and variable loan rates all repriced within days or weeks of each Fed move. That asymmetry has a name banking analysts actually use: deposit beta. If the Fed raises rates by a full percentage point and your bank raises your savings rate by 40% of that, your bank's deposit beta is 0.40. Large, well-known national banks often run deposit betas in the 40 to 50% range, but plenty of smaller banks, with what the industry calls sticky deposit bases, customers who've banked there for years and simply never leave, run deposit betas under 30%, meaning less than a third of an entire Fed hiking cycle ever reaches those customers' accounts, even years later. And here's the part that matters most. Banks aren't guessing about this. The data on deposit stickiness is well understood internally. Most retail customers simply do not move their money in response to a rate difference, no matter how large that difference gets or how long it persists. Banks price accordingly, quarter after quarter, year after year. Pillar 3. What that stickiness actually costs someone in real dollars, and it's bigger than it first sounds. Picture a saver who opened an account years ago and has simply never compared it to anything else since, which statistically describes most people's actual banking behavior. At many of the largest banks, that account might still be earning somewhere between 0.01 and 0.50%, while online banks and credit unions are currently offering 4 to 5% on essentially the same FDIC-insured product. On a $50,000 balance, that gap works out to roughly $2,245 a year, not a one-time fee, a recurring invisible cost every single year for as long as the money sits there, unmoved. Nobody sends you a bill for this. There's no line item. It's simply interest you were never paid on money that was, this whole time, perfectly safe to move somewhere else. This is also exactly why the national average looks the way it does. Most Americans keep the bulk of their money at a small number of very large, very old, very well-known banks, many of which still pay as little as 0.01%. Because so much of the country's total deposits sit there, those low rates pull the entire national average down, even while better options sit one search away. According to one industry comparison, online banks pay rates roughly 314% higher, on average, than traditional branch accounts, a gap that exists specifically because branch banks compete less on rate and more on the simple fact that most customers never leave. And the gap isn't limited to basic savings accounts either. The same pattern shows up across nearly every deposit product. The average interest checking account currently pays just 0.07%, while a one-year certificate of deposit averages closer to 2.5% for savers willing to lock their money up for a fixed term. Credit unions, structured as member-owned rather than shareholder-owned institutions, have raised their average rates roughly five-fold over the past decade, moving from about 0.25% in 2016 to over 1% today, landing meaningfully higher than traditional banks on the exact same account types. None of these differences reflect different risk. FDIC and NCUA insurance, where each applies, covers deposits up to the same $250,000 limit, regardless of which of these you choose. So, 3 pillars. The spread itself. Net interest margin, the basic, public, quarterly reported engine behind most bank profit. Deposit beta, the deliberately slow dial that decided how little of an entire multi-year, multi-point Fed rate cycle actually reached ordinary savers versus how quickly that same cycle reached borrowers. And the loyalty tax, the real, compounding, entirely legal cost of staying in the same account for years without ever comparing it to anything else, quietly widened by the fact that most of the country's money sits in exactly the accounts paying the least. None of this requires a villain. Banks are doing exactly what their own public quarterly filings say they do, in plain sight, every 3 months. The only lever that's actually yours to pull is the one most people never touch, moving the money. The same FDIC insurance protects a 0.38% account and a 4.5% account equally. The safety is identical. The return, quietly, is not. If this made one more part of your bank statement a little less invisible, that's what this channel is for. Money, explained with the receipts on screen, not vibes. Next video, we're looking at something almost everyone has and almost nobody questions: the free checking account, and exactly how a product with no monthly fee still turns a real profit. Subscribe so you don't miss it. See you there.